Good morning. My name is Robin Miller, and I'm Senior Corporate and Tax Counsel for Pro Bono Partnership of Atlanta. Today, I'm joined by Richard Litwin of Litwin Law. Richard focuses his practice on state and local tax controversies, including sales and use tax, local county taxes, corporate income taxes, property tax, and basically anything tax in Georgia. He was selected as a Georgia super lawyer, and to PBPA, he's not only a super lawyer, he's Superman, because he takes on a ton of our sales tax and property tax projects for our clients, so we appreciate it. And I'm really excited about this presentation because I'm hoping that you all will learn quite a bit about sales and use tax. The mission of Pro Bono Partnership of Atlanta is to provide free legal assistance to community-based nonprofits that serve low-income or disadvantaged individuals. And we do this by matching our clients with volunteer attorneys from leading corporations and law firms in Atlanta who can assist our nonprofits with their business law matters. The next slide tells you about how to become a client of ours. To be eligible, you need to be a 501c3 organization. You need to be located or serve the greater Atlanta area, serve low-income or disadvantaged individuals, and be unable to afford to pay for legal services. Please visit us at our website, which is listed on the bottom of the slide. Also know that we have hundreds of resources on our website on various topics, and also multiple webcasts that you can watch on other topics. Today's webcast is, of course, we are providing you general information, not specific legal information, and it's copyrighted. We're going to begin with the framework of sales and use tax in Georgia so that you have that overview and understand what it's all about and how it works. And Richard's the expert, so he's going to take us through that. One thing I want to mention, and we'll talk about this a little further, is that the Department of Revenue is working on an information bulletin regarding sales tax for nonprofits. It is not out yet, and so our comments are our own as we talk through some of the fundraising models that we'll get into later today. We do not know exactly how the Department of Revenue is going to come out on these issues, and so to the extent that there are any changes from what we say today as our own thoughts on these subjects, we will do another webcast to update and make any changes as needed.
Okay.
Ready?
I'll start, Robin, by saying, and this is kind of a little bit of a deviation before we hit the slide, that I want everybody out there to understand that a sales tax number, which is issued by the Department of Revenue, is not the federal employer identification number. A lot of people try to think, oh, well, that's what my sales tax number is. No, it's not. A sales tax number is actually applied for with the Georgia Department of Revenue. It doesn't even have the same number of digits that the employer identification number has. And that's going to be very important as we kind of go through the material. But let's start with sort of the background on what is sales tax. What is a sales tax? It's basically a transactions tax, and it's imposed on retail sales of tangible personal property. That's a mouthful. We'll talk about the specified services that are subject to sales tax. Georgia doesn't have a bunch of them, but we'll talk about those later. What I want to focus on right now is retail sales of tangible personal property. Tangible personal property, before we get to retail sales, tangible personal property is what you probably imagine it is. It's anything that can be touched, measured, weighed, pencils, boats, computers, paper, canned software. It's not real property. It's not intangible property. So it's not anything like customized software or stocks or bonds or trademarks or copyrights. So you don't pay sales tax when you buy a home or you lease space. Now that's what tangible personal property is. And I said that it's an excise tax that's imposed on retail sales. Retail sale means it's the sale, or it can be a lease, for any purpose other than for resale. And that basically means to the end user. So if I go to a store, Perimeter Mall, and I buy a shirt, I'm the end user, I pay sales tax. It also includes rentals. If instead of going to the mall, I go to a rental place and I rent a ditch witch for the weekend, I pay sales tax on that. But most important for everybody out there who have nonprofit events to raise money, retail sale also includes charges for admissions. Charges for admissions to places of entertainment, exhibitions, sports, amusement, or really any place where admissions is charged. Now, it doesn't include voluntary contributions, but if you charge for an admission to a gala or an event, you have to collect sales tax. And we'll talk more in our scenarios about whether you can bifurcate the charge for the gala or the event into some sort of fair market value and some sort of voluntary contribution. Now, retail sale also includes charges for participation in games and amusement activities. What am I talking about there? We're talking about entry fees for a fun run, or for a marathon, or for a race, or any kind of tournament. So these are things that, as folks that are nonprofit organizations are getting ready to have their events, need to be cognizant of these rules. Still staying on this first slide, that third arrow there, tax must be added to the sales price or the purchase price. I'll use sales price and purchase price interchangeably. I always say it's a good idea to make it a separate line item. You have your charge for the sales price, and then you have a separate line item for sales tax. And then finally, sales price, as you see on the slide on the computer, it doesn't include everything you get from the purchaser. It's definitely cash, credit, property. If you're doing bartering, that constitutes a sales price. But sales price does not include some things. It does not include retailers' discounts. Everybody's familiar with this. It's a little in-store coupon that you get in the mail pretty much every day. You see one of these in the mail, or twice, 3 times a week. If I take this coupon to Bed Bath & Beyond, it's for 20% off, and I buy something for $10. I pay $8 for the product, and I pay sales tax on the $8, not on the $10. There are other things that sales price does not include. It does not include finance charges that are separately stated. It does not include separately stated installation charges. It does not include a credit for a trade-in. We'll talk about that as well, but I just want to make sure that the folks out there understand that sales price doesn't include everything that's being charged. Next slide. Now, what is the use tax? The use tax is really just a complement of the sales tax. I tend to say it's sales and use tax. Don't be confused so much by, well, is it use tax or it's sales tax? I said in the beginning it's a transactions tax, so let's just call it the sales and use tax. But if you want to be picky about it, nitpicky about it, it is a complement of the sales tax. The use tax historically was designed to prevent tax avoidance, where you're in Florida maybe at an outlet store and you buy something and they say, hey, you don't have to pay sales tax, we'll ship it. And you don't have to pay sales tax. Well, you don't have to pay Florida sales tax because you're not taking possession in Florida. But you do have to pay use tax, and use tax has grown in importance due to the growth in e-commerce. So we have a lot of out-of-state internet sellers that have no, what we call, nexus or connections with Georgia, and they don't have an obligation to pay or to collect Georgia sales tax. So if a nonprofit organization buys supplies, a lot of supplies from an out-of-state internet seller that does not collect the sales and use tax, the nonprofit here in Georgia has an obligation to pay, to basically what they call accrue and pay the use tax to Georgia. There's actually a form for that. That's on the slide, the third dash there, the form ST3USE. And then finally, the use tax has changed a little. We're in a very kind of dynamic, fluid area of the law when it comes to sales and use tax and internet sales. I'm sure a lot of folks know when they buy shoes on the internet, some of the vendors don't collect sales tax, some of them do collect sales tax. A lot of that is going to change. You're going to see a lot more of these vendors having to collect the sales and use tax because of the Wayfair decision that came down about a year ago, which basically says that even though an internet seller does not have physical presence in a state, that state can still require the internet seller to collect its sales and use tax under certain conditions. And those conditions primarily are tied to the amount of sales that the internet seller has in the state. We're not going to get too wrapped up in the Wayfair decision, but I just want folks to understand that a lot more of your vendors and suppliers, perhaps in the past, didn't collect sales tax. They're going to start doing it in the future. Next slide. Now, I mentioned in the beginning that some services in Georgia are subject to sales tax. In some states, a lot of services are subject to sales tax. In Louisiana, you pay for parking, you pay sales tax on parking. In Georgia, only the enumerated services listed in the Georgia Revenue Code are taxable. That's that first dash there on the slide. So, what am I talking about? Charges for telephone service. You have a phone, I have a prop here, you have a phone, you pay sales tax on your telephone service. Electricity, you pay sales tax on it. Transportation services, taxi cabs, limo services, you pay sales tax on that. Hotel rooms, for less than 90 days, you pay a sales tax on that. And cabin rentals. Folks in the cabin rental industry about 4 or 5 years ago got hit by a lot of audits by the Georgia Department of Revenue because they were not collecting sales tax on cabin rentals. Now, professional, second dash there, that professional or personal services with maybe an inconsequential transfer of tangible personal property, those services are not taxable even though there is a transfer of tangible personal property. So what do I mean here? You go to an accountant, you get a compilation done or a report done, they give you the report, you pay $5,000 for it. You're not buying a product from the accountant, you're buying a service that happens to have this inconsequential transfer of tangible personal property. You go to your cleaners every day or whenever you go to the cleaners, and they give you back your shirt with a hanger and the plastic wrapping. Well, you're not paying for the hanger and the plastic wrapping, you're paying for the service. So even though there's some transfer of tangible personal property, it's inconsequential, and the true object there is really the purchase of a service. I mentioned their third dash there that separately stated installation charges and labor are not taxable, but it must be shown as a separate charge on the invoice. If labor and installation charges are not separately stated on the invoice, then the entire invoice price is subject to sales tax. In the interest of time, I know we have 2 more items on this slide, but in the interest of time, I'm going to skip over fabrication, labor, and mixed transactions simply because I've kind of talked about the true object test already, and we don't really see a bunch of fabrication labor in this area of the world that we're doing. So we'll go next to the next slide, exemptions. Let me start by saying that we have statutes in Georgia, the code, and then we have regulations. So each state agency, in most states, in the federal government, draft regulations that sort of interpret what the law says or what the code says, and we have the same thing here in Georgia with sales tax. But I want to make sure everybody's clear that exemptions from sales tax are statutory. You're only going to find them in the Georgia Revenue Code. You're not going to find them in a bulletin. You're not going to find them in the regulations. If there's an exemption, it will be in the Revenue Code. As you can see on the slide, there are 3 different types of exemptions. There's entity-based, use-based, and product-based. So entity-based exemptions are specific exemptions in the code that are given to specific entities so that they can buy things tax-free. For instance, Rock Eagle, Georgia, which is on the way to, I guess depends on where you're going, but for me, it's on the way to Augusta and Columbia. Rock Eagle is just sort of south near Eatonton, and the Rock Eagle 4-H Club doesn't have to pay sales tax because they have a specific exemption. Some charities actually have a specific exemption. Governmental entities don't have to pay sales tax. The Boy Scouts and the Girl Scouts do not have to pay sales tax. Some nonprofit health centers and food banks are specifically exempt. So you can see those are entity-based exemptions that because of this particular entity, they don't have to pay sales tax. Then there's use-based exemptions. I'm talking about exemptions that are applied based on how the item is used by the taxpayer. For instance, if I go buy ice for my Super Bowl party, I pay sales tax on it because we're buying it for ice for the Super Bowl party. But if it is used to chill poultry, that ice is not subject to sales tax. If I go buy sugar at the grocery store, I typically, well, that's probably not a good example, but I pay some sales tax. There is a food exemption, so the state tax doesn't apply, but it is subject to sales tax. But if a company makes cookies and buys massive amounts of sugar as an industrial ingredient that goes into a product that it then sells, it does not have to pay sales tax on that. So it's how the product is being used. Certain machinery in most states is exempt from sales tax, or the purchases, because it's being used to make a product for sale. Then there's finally product-based exemptions. And product-based exemptions are, as the name might imply, they are provided for specific products. They're available for specific types of property sold. For instance, in Georgia, as you can imagine, we're in an agricultural-based state, so sod is not subject to sales tax, seed, fertilizer, moving into things that we're more familiar with, food for off-premises consumption is not subject to the state tax. It's subject to the local taxes, but it's not subject to the state tax. When we go to the grocery store and we buy a head of lettuce, we don't pay the 4% state tax. Prescription drugs is not subject to sales tax, and I got to qualify that. My dog Lily takes Prozac, and we pay sales tax when we buy the Prozac. We pay the full price and we pay sales tax because Lily is not a human, so we have to pay sales tax on her Prozac. There's other products that are not subject to sales tax, lottery tickets, for instance. And then finally, how do we construe exemptions? If you're looking at these exemptions and you think, well, gosh, maybe this might apply to our business, one rule to remember, it's sort of black letter law, is that exemptions are construed narrowly against the taxpayer. So if there's any doubt about whether the exemption applies, you have to assume that it does not apply.
A question about the last slide. You said that there's
Can you go back to the last slide?
entities that are listed in the statutes, but those are specifically named by the organization entity, like Rock Eagle 4-H Club. Is
Yes.
All 4-H clubs.
Right, that's a very good question. It's actually, and we'll talk about some other specific entities in a few minutes, but actually it is named as a specific entity that does not have to pay sales tax.
But there are some where it's a category of entities, and we will talk about that. Richard will cover that in a few slides.
One other question, which might be covered later on. What if you're purchasing the product not as the end user, but to resell it?
Well, that's a great question. If you're buying a product to resell, you do not have to pay sales tax, but whoever you're buying it from, the seller, is going to want something called a resale certificate, which we will get into. And I will hold it up, another prop, thank you. I will hold it up. This is the Form ST5, which is actually used. You have to have a sales tax number, though, and we talked in the beginning that a sales tax number is not your employer identification number. And you have to fill this out, and then you give it to the seller, and then the seller takes it and doesn't charge you sales tax.
Okay.
Because it's being purchased for resale.
Okay. Thank you.
Sure. So moving on to
The next slide.
the next slide.
Which is that.
Exemption certificates. Great segue from that question. Exemption certificates, I just showed everybody out there in the internet world what an exemption certificate looks like. It's the Form ST5. You can go to the Department of Revenue's website and pull it. Why are these important? If we're selling stuff out there and a purchaser comes to us and says, well, I'm exempt, I don't have to pay sales tax, you got to get this exemption certificate from them. And why is that? Because of that first dash there, sale is always going to be presumed to be taxable retail sale. It's always going to be presumed to be a taxable retail sale. Even in the issue of the question that was just asked, clearly it's being bought for resale, but it's always presumed to be a retail sale that's subject to tax until the opposite is shown. And the seller has the burden to show that it's not a taxable retail sale. Now, to be relieved of this burden, the seller must collect the tax, of course, or get an exemption certificate in good faith. And we're going to talk about what that means in just a second. So the seller must get a properly completed resale or exemption certificate and get it in good faith. The second dash there, it has to be properly completed. What do I mean? Again, my prop, all these blanks have to be filled out. And the seller has to check it. That's part of the good faith aspect of it. But the Department of Revenue has these forms on their website, and all the blanks have to be filled in. As I said earlier, for many exempt entities, a sales tax number is required. In some situations, a sales tax number is not required, but you have to look at this thing, and that takes us to the third dash there, in good faith. So if you're a seller and someone gives you an exemption certificate and says, I don't have to pay sales tax, here's my exemption certificate, you must really, if you're going to be acting in good faith, which you're required to do, you have to verify that the sales tax number is valid. And you can do that by going to the Georgia Tax Center portal at the Georgia Department of Revenue's website. There is a number there that you can call, a toll-free number that will tell you, where they'll give you instructions on how to check or verify a sales tax number. The bottom line, and that bottom dash there on the slide, is that if a retailer fails to get the certificate, you must then collect the sales tax. You have to collect the sales tax. Otherwise, if the retailer is subject to an audit, they'll say, why didn't you collect sales tax? And then your response is, well, they told us they were exempt. Did they give you an exemption certificate? No. Well, you got to pay it because you should have collected it. So can we go to the next slide? Now we're getting into purchases and sales.
Can I ask you a question?
Sure.
So the nonprofits that might be buying something for resale, they can go on to the Georgia Tax Center and register and get an ID number, sales tax number, not a federal identification number, but a sales tax number. And then they can fill out one of these forms properly if they really have a reason for it, if they're going to resell something. But they can't just get it because they're a 501c3 and say they're exempt.
That's a very good point. As a matter of fact, there are folks that, believe it or not, will form a business just so they can go to places like the Atlanta Apparel Mart or Merchandise Mart and buy things and say they're reselling it when they're really not. And that goes on a lot. And you've got to be reselling things. You can't just fill out their certificate, as you noted, and say, well, I don't have to pay sales tax now because I'm buying everything for resale. You've got to be buying it for resale, which kind of is a good point. It dovetails into the point about taking the certificate in good faith. If you're on the other side of the transaction and you're the seller and someone gives you a resale certificate and says, well, I'm selling these things, these 36 cases of Coca-Cola, I'm going to be reselling them, and they're a pet supply store, you got to ask questions. Well, maybe they're really not reselling the Coca-Cola, so we should be very careful about not charging the sales tax.
And then separate from that, if I'm a 501c3, I can't just fill out one of these forms and that makes me exempt either. It's only a resale certificate, correct?
Well, this form actually does apply to there are several boxes you can check. There are 7 boxes you can check. This is the general exemption certificate form. So most resellers, as you can see at the very top of the form, it says, I don't have to pay sales taxes, I'm buying this for resale. That's box 1 that you check. But there are other boxes that you can check. Then there are some exemption certificates that apply just to the organization.
Right.
So there are other exemption certificates. This is not the only one that exists.
But it's specific to those different purposes.
Correct.
So 501c3s aren't generally exempt from sales tax.
That is correct. We'll talk about that in just a second. In fact, that's our next point.
Right.
Good segue.
There we go.
So that first point there, and we're talking about purchases now. We're not talking about sale. Let's get ourselves in the purchase mode. We are buying things. We're in buying mode, as I'll say. There is a regulation that says a nonprofit cannot buy things tax exempt. It specifically refers to churches, religious organizations, charitable organizations, civic organizations. That second dash there. They must pay sales tax on purchases of items for their own use. The third bullet point is a DOR information bulletin. Just an example, a PTA had to pay sales tax on its purchase of band instruments that it was then going to give to the students. It might have been a 501c3, the PTA, but it still had to pay sales tax on its purchases. And then that final bullet point or dash there is that some exemptions allow specific entities to buy tax exempt. And let's talk about that because that's something that has come up as a question from the folks watching this. I can go to the next slide. So these are some specific entities that don't have to pay sales tax on their purchases. You can see there the American Red Cross, the Georgia State Daughters Society of the Daughters of the American Revolution, Girl Scout, Boy Scout purchases used for fundraising. And then there are some 501c3 Robin organizations that if they have a commissioner's letter from the Department of Revenue, they don't have to pay sales tax on what they buy. These inpatient nursing homes, inpatient hospices, inpatient mental hospitals, and through 2021 food banks. And these are specifically provided for in the Georgia Sales Tax Code. We can go to the next slide.
And there's definitions of each of these as well in the code. To a
I
certain
think
extent.
it will say Boy Scouts and Girl Scouts. It doesn't necessarily say this is what qualifies as Boy Scouts and Girl Scouts. Continuing on with exemptions on purchases, University System of Georgia units and it's, in the University of Georgia, they don't have to pay sales tax. Purchases by private colleges and universities whose credits are accepted by the University System of Georgia, they don't have to pay sales tax. Purchases by private elementary and secondary schools, food for consumption by pupils, items used exclusively for educational purposes. Now, the school must be approved by the Department of Revenue as an organization eligible to receive tax-deductible contributions. And this is all set out in the code regarding this particular exemption. And then you'll see there's these last two on the slide, educational, cultural institutes sponsored by a foreign government. These are all specific entities that are listed in the tax code, the sales tax code. Let's go to the next slide. Here's where we kind of get into the meat of the presentation. Of course, I have a cookie on the slide and I'm talking about meat, but we're talking about sales now. We've shifted from purchasing mode to sales mode. So now we're a nonprofit and we're getting ready to have a gala and we're going to start selling things, like tickets, sponsorships. Maybe we'll sell other things to raise money. Generally speaking, a nonprofit organization is required to collect sales tax on sales of tangible personal property, which we've already talked about, tickets, or just plain old admission charges, because at this point with the internet, I don't even think you have to sell tickets anymore. You just go on the internet and sign up for something and you're registered. Maybe you get a number or a confirmation code. Entry fees. You have to collect sales tax on entry fees. We'll cover some of those later in the scenarios that we're going to cover. Now, some groups are relieved from the obligation to collect sales tax. I was just talking about PTA organization. PTAs that are exempt under 501c3 of the Internal Revenue Code, they do not have to collect sales tax. Private or public school events. So, tangible personal property, concessions, tickets for admission to a football game or a basketball game or any kind of event or function, as long as the net proceeds from the sales are used to benefit the school or the students. So the school, and let me just talk about this for a minute. You go, typically for me, my high school is Pope. I go to a Pope high school football game. I pay $5 to get in at the gate. I don't buy nachos. In fact, I don't buy anything from the concessions, but people buy from the concession stand. Those really are exempt. But then you've got folks over at the Booster Club area always selling stuff. There's where you've got a fine line there, because Booster clubs are not the school. They're the booster club. And they've got to be careful about saying, oh, well, we're the school. They're not the school, and booster clubs have to collect sales tax and should be. So, like I said, you get to a football game or a basketball game, you've got a lot of different sellers out there. You got the school, which is exempt, but the booster club is not allowed to dovetail off of the school's exemption from having to collect sales tax. Back to the slide, third dash there, we can't talk about this enough, I guess. Girl Scout sales and cookies, Boy Scout sales or for food and food ingredients, and the one thing that I can point out, that comes to mind is the cookie sales. So when you go and you pay, $3 for the, I'm sorry, what kind of cookie is that on the slide? Samoa. You pay $3 for the Samoa.
$4 now.
Is it $4? Okay.
$4.
Got it. There's no sales tax. Okay. And back when I was in my younger days, I would always try to get cute and say, why aren't you collecting sales tax? And my wife would look at me funny, and she'd grab me, and we'd go into the grocery store. But I finally one day looked, and I saw, well, they're not collecting sales tax, so they don't have to. And then finally, that last bullet there, that last dash, religious institution fundraising. So this is a big deal for churches, synagogues, mosques, anybody trying to raise money. This has several qualifiers, though. Number one, a religious institution fundraising event has to be a specific charitable fundraising activity that cannot exceed 30 days in a calendar year. So if you're a church or synagogue and you're going to raise money for the building maintenance, your activity cannot exceed 30 days. The proceeds cannot benefit a private person, and the proceeds must be used for purely charitable purposes, such as relief to the aged, youth activities, religious institution or worship, construction or repair of the building or facilities. And then finally, it's not on the slide, but certain fine arts performances until July 2020, you'll see a lot of these exemptions having these sunset provisions where in a year or so they just die and the exemption doesn't exist anymore, and that happens to apply to this one. So certain sales of tickets or fees or charges for admission to fine arts performances that are performed or exhibited within a facility owned by a 501c3 entity. Point of the matter is, I don't want to get into the details of this exemption, is there are certain exemptions out there for certain entities or certain types of events. Next slide, please. So the slide doesn't do it justice because it's not big enough, but I try to find a slide that would really highlight the number of counties we have in Georgia, which is 159, and they all have their own tax rate. I don't want to spend too much time in this webcast talking about the different tax rates. There's the state rate of 4%, and then every county has a local rate, or maybe 3 or 4 local rates. The point I want to focus on this slide is the third bullet point about the delivery address. So when you're collecting sales tax, you've got to remember that if you're shipping a product to Wayne County, Georgia, or Hazelhurst, Georgia, or Cuthbert, Georgia, that's the tax you have to collect, is that particular county's tax, not your county tax here in Metro Atlanta or wherever you're located. The second thing to remember about the rates is that if you have an event, maybe you're going to have an event in downtown Atlanta, but your business is located in Gwinnett County, you collect the tax based on the venue of the event. So if your event is in downtown Atlanta, that's 8.9%. That's the tax you have to collect. The nice thing, the problem, one of the things I see these nonprofits that are collecting tax, but they're collecting the wrong amount of tax. A lot of nonprofits simply don't understand that if they're shipping to another county, it's the delivery address that sort of drives what determines the tax rate, not where it's being shipped from. Very important point to remember when you're selling product.
Or holding events.
Or holding events, exactly. Can we go to the next slide? So this kind of just summarizes, I guess, the good news or the bad news for nonprofits about collecting tax. You know, as I said in the beginning of this webcast, Georgia is a transaction state. The Department of Revenue can collect it from the seller or the purchaser. So, you know, I had a law partner years ago who used to say, well, if they're not collecting tax from us, I'm not paying sales tax if they come asking for it. And I said to him, well, we have to pay sales tax or use tax because the Department of Revenue can collect it from either one of us, either the seller or the purchaser. A lot of times, the Department of Revenue will come in and audit a company, nonprofit or for-profit, and they'll ask for purchase invoices, and they'll say, well, you didn't pay sales tax on all these purchases. And the taxpayer will say, well, I didn't have to because they didn't collect it. And the Department of Revenue says, oh, yes, you do have to pay it, and here it is. Here's your bill for the sales tax that you should have paid to the vendor that the vendor didn't collect. It's called the use tax. But anyway, as far as collecting the tax, I have said again and again, I'll say it on this slide, you add the tax to the invoice. You add the tax to the invoice as a separate line item. I think if you're holding a gala or you're holding an event or you're selling product, you should always add the tax as a separate line item. Why is that so important? Because you're collecting the tax as an agent for the state. And if the state comes in and doesn't see the line item on your sales invoice, they're going to say, well, how do we know that you collected the right amount of tax? Because you don't have it as a line item. Now, there are certain circumstances by which or in which you can include the tax in the total price. I don't advise anybody to do that. I think you should do a separate line item. But you know, and we all know, if we go to a movie this weekend and pay whatever amount we pay for movies these days, $12, we don't see a sales tax line item because they include it in the price. Now, whether that's right or wrong, they're allowed to do that. I just don't advise any nonprofits or other taxpayers. I don't advise you to do that. You're collecting it as an agent for the state. Now, how do you actually remit it? Each month, you will see on the slide there, you file a monthly report. It's called the ST3. It stands for Sales Tax 3. And you file everything online at the Georgia Tax Center web portal. That's where you remit the tax. That's where you file the form, and you literally fill out the form online. It's due by the 20th day of the month after the sale. So we're in May 2019. Our sales tax return is going to be due by June 20, 2019, regardless of whether that's a Saturday or a Sunday or a holiday or your birthday. You got to do it on by the 20th day. Of course, I tell clients, don't wait till the 20th. Put down the 19th as the due date. You have to remit the payment too by the due date as well. Again, this is all done at the Georgia Tax Center online web portal. And then I said the Department of Revenue can also collect from the purchaser consumer use tax. I think I've plowed this field a number of times already in this webcast, but I will say again, I have many clients who buy things over the internet, and the internet seller doesn't collect the tax, and so they think, as my former law partner used to say, well, if they don't collect it, I don't have to pay it, and that's just not the case. You do have to pay it. You have to actually file a return. We call it accruing the tax and remitting it over to the Department of Revenue. And then finally, this remote seller rule and the virtual nexus, I'm not going to get into that too much. Just bear in mind for the folks out there that are buying things over the internet, you're going to see a lot more of these internet sellers having to collect the tax. And if you're a nonprofit selling over the internet, this rule may apply to you. So if you're selling to other states, and the other states have what's called the 100-200 rule, meaning you're selling into that state 100 transactions in a calendar year, or $100,000 in transaction sales, or 200 unique transactions, you have to collect that state's sales and use tax. But that's kind of beyond the scope of this webcast.
Richard, we have a question here. If a 501c3 pays sales tax to the event venue, do they have to charge this tax on to the person buying an admission ticket?
We're going to talk about that in a few minutes.
Okay.
Hold that thought. Yeah, okay.
Very good question. Okay, next slide.
Oops, sorry.
Obligations as a seller, as I've said, if you're a seller, you have to register If you're not registered, you need to consider submitting a voluntary disclosure to the Department of Revenue through counsel to get registered, because you have potential liability for not collecting sales tax in the past. Then you file the form, you start filing monthly, and if your sales are not significant, they'll move you down to quarterly, and then like me, my firm, I actually file annually a sales tax return. As a purchaser, you have to register as well. Let's go to the next slide. Okay. Can we go one more slide? Okay, I'm skipping through a little bit in the interest of time. This is just a letter ruling that I want to use as sort of a backdrop for what we're going into with the various scenarios. The Department of Revenue was presented with a case scenario of a driving range that wanted to know whether it needed to be collecting sales tax on batting cage tokens and practice range balls and that sort of thing. The Department of Revenue responded by saying, look, what you're charging is charges for participation in games and amusement activities. I don't necessarily feel that games and amusement activities encompasses batting cages and the practice balls, but the Department of Revenue views that very broadly, and so it's important as sort of a backdrop for the scenarios that we're getting into, that you understand that here in Georgia, participation in games and amusement activities is not limited to what you see at the county fair every fall. If we can go to the next slide. And then my final slide is sort of a backdrop for entry fees. In 2017, the Department of Revenue issued a bulletin that said three things. Number one, Georgia imposes sales tax on charges made for participation in games and amusement activities. Number two, Georgia also imposes tax on sales of tickets, fees, or charges for admission to places of amusement, sports, entertainment, or to any other place at which any exhibition, display, or amusement or entertainment is offered to the public, or any place where admission fee is charged. And then number three, the department said if spectators are charged a taxable admission fee to a game or amusement activity, then the participation or entry fee charged to the participants in the same event are not taxable. So according to the Department of Revenue, entry fees are taxable charges. This is a big shift in what I think folks out there on this webcast who are having, fun runs or races or anything to raise money that involves an entry fee, you got to collect sales tax. Marathons, it begs the question, will that extend to, the charge for my health club or, Sandy Springs Tennis Center? Do they have to collect sales tax on, my playing tennis for an hour? Homeowners Association dues, I think that's a stretch, but, my dues go to playing tennis every week at my tennis court. At any rate, that's sort of the backdrop, and I'll move on. And
on the last bullet point, if the spectators are charged, so think of like a cheerleading event where there's a competition, and it's at the George World Congress Center. And in order to get in to watch the competition, you have to pay $10 a day, for instance, or for a fee for the weekend to see all the competition. If the person is charged sales tax on that fee, on that entry fee, just to watch, then the teams that are participating will not have to pay tax on their entry fee. And that's what this bulletin is covering.
Exactly.
So it's an exception to the rule, essentially, which is what Richard was covering, the general rule, which is that you pay to enter.
Exactly.
All right, let's now turn to these fundraising models. So now you've got the backdrop, and now we're going to cover some of these common fundraising activities that a lot of our clients and other small nonprofits deal with, as well as large nonprofits. Like I said at the beginning, the Department of Revenue is currently working on an information bulletin on these issues. We're hoping it'd be out by now. We're hopeful that it'll be out within the next month or so. What we say today is our view on these subjects. We do not know exactly how they're going to come out on it, and we will let you know if there are differences. So these are the different subjects we're going to try and cover very quickly in the next 15 or so minutes. Next slide. So let's talk about items to donors as a token of appreciation. Well, what are we talking about? Well, NPR does this all the time, and they do it really well. They will have a fundraising promotion campaign for a week or 2 weeks, and if you give so much money, maybe you get a mug, or you get a bag, or you get some logoed item from NPR. And it's a small gift. It's something that you're given as a thank you for giving the donation. So the donor makes the contribution and the organization gives that token. The organization, if it's truly a token item, and we're going to talk about what constitutes a token item, but if it is truly a token item, the organization must pay sales tax as the end user. They purchased it and they're giving it away. So they're the end user. So they can't go in with their resale certificate because they're not reselling it. They're giving it away. So they have to pay sales tax there. So the donor, let's say, gives a $75 check, and the donor receives a mug with a logo of the organization on it in return. And let's say that mug costs $5. The organization pays the sales tax on the mug, and the organization does not charge the donor for sales tax. And the reason for that is that it is considered a low-cost article. It's not something of value that they're receiving in return. There's no transaction. There's no sale of tangible personal property. It's a little thank you. And if you look at it from an IRS perspective, the IRS has the same kind of rule. And this rule changes from year to year as what constitutes a low-cost article. On our website, we have an article that we update every year that's called The Rules for Giving Small Items in Return for a Contribution. And it covers this. And the amounts change every year because it's adjusted for inflation. So it's a little bit amusing when you read the numbers and understand how it's set up. So in 2019, if a donor receives something in return, makes a donation of $55.50 or more, and they only receive some item that's logoed item, something like that, that costs no more than $11.10, then there's no sales tax charge from a tax perspective, a sales tax perspective, but there's also, you don't have to put on your donation receipt that they receive something in return of a value. It's a gift, and you don't have to worry about that. It's not like the situation where maybe I pay $75 and I get a $25 sweatshirt. Well, that would then be something that on my donation receipt, it would have to say, you received goods and services valued at $25. And by the way, sales tax was charged on that at X amount. So that's the difference with that scenario. And that's where it's truly a token of appreciation. It's really important to document this and keep really good records of these kinds of sales promotions. You want to make sure that the organization is documenting that when it bought the items, that it paid sales tax, or if they were donated, that in fact they were donated, and then it's on the donor to pay the sales tax. That the organization in fact had a fundraising campaign and the details of the campaign and how much, what the campaign was. And then the value of the item given in return, of course, is really important to prove that it meets that low-cost article amount. Moving on to our next scenario. We have put together all these different kinds of events because they all have certain things in common. So we've got festivals and block parties and your taste ofs and your carnivals and your fairs, and they all sort of have the same elements. So we've kind of put them together. The first bullet point is that sometimes they charge for you to get entrance into the festival or the fair or the carnival. And if there's a charge for admission, which Richard has clearly described and talked about, sales tax must be collected on those charges for admission because it's admission to games or amusement. So if there is actually a fee to enter the area to participate, you have to charge sales tax on that. Now let's move into sort of the other components, because oftentimes there isn't a charge to get in. You know, Taste of Alpharetta. You wander around the streets, there's all these booths out there or locations where each of the restaurants are located, and maybe there's some stores and other different booths. So you've got the little booth location, and usually the charity is charging for a booth rental to the restaurants or to the stores. Then there's the entry fee or tickets. So there can be or really food and beverage tickets, right? So if it's a taste of, you've got all these vendors and you go and you pay 3 or 4 tickets and you get a taste of whatever the food is. So you have to buy those. We're going to cover that. And then there might be games or carnival rides associated with that at one end of the event. And you usually have to buy tickets for those. So we're going to break it down. So the booth rental by the restaurant or business or gamer is a fee, but it's a fee for the limited use of real property. It's buying that square of land to set up your little spot. And so that is not the sale of tangible personal property. There's no sales tax to be collected there. Tickets for food and drink, on the other hand, clearly falls within the sales tax component. You have got a charity that's selling a ticket, maybe it's $1 a ticket, maybe for $20 you get 25 tickets, and they're using it to buy food and drink. And in that case, that's tangible personal property, and sales tax should be collected on those tickets. Jump in anytime you need to. It does not matter if the restaurants are donating the food, if for the purpose of the ticket sales and the collection of sales tax in conjunction with the tickets. That's irrelevant for that purpose. Now, the restaurant might be able to, if the restaurant is donating the food, then they're the end user, and they can't use their resale certificate to buy the food ingredients.
What typically happens, though, Robin, is the restaurant will have already used its resale certificate to buy that food and ingredient, and the restaurant probably has to accrue its own tax on its purchase price. That's something, though, that the restaurant needs to worry about on its own. That's just a side item.
Great. Now, if the restaurant tracks the tickets in some of these events that happens, and the charity actually gives some portion of the dollar per ticket to the restaurant, then the restaurant can purchase them for resale, and then they don't have the issue that Richard was talking about. So clearly from the charity's perspective, the most important thing is that if they're selling food and beverage tickets, they should be charging and collecting sales tax on them. Now, what about those carnival game rides, the carnivals and the games and so on at the other end of the event? That's participation in games and amusement, and that sales tax is supposed to be collected on the cost of doing that. So it is subject to sales tax. Oftentimes it's the same ticket, so that makes it really easy. Doesn't matter what it's used for, you've got to collect and remit sales tax on those items. Any questions? Can I move on to the next one?
And the same result, whether the carnival vendor provides the rides and games for free, at costs, or a marked up fair market value. It's the same result. You got to charge for those tickets.
That's right. All right, now we're going to move into galas and silent auctions, which is really the biggest issue.
Piece, yeah.
And this is one that's not 100% clear. We're not exactly sure how the Department of Revenue is going to come out on this. We have some ideas of two different options, and we're just going to kind of have to wait and see. And we'll describe both scenarios. But basically, there's two different events. You've got the gala part, and then you've got the silent auction piece. We're going to start with the gala. So the average gala by clients our size include, maybe you pay $100 per person, and you get a chicken dinner and maybe a glass of wine or beer or soda that comes with it. And usually there's some kind of DJ playing some music in the background, or some little band no one's ever heard of, often voluntary. And so you're not really going there for the entertainment. You're going there because you want to do something good for this charity. But there's a value to that chicken dinner and that drink that you've gotten. Probably not a value to the entertainment. You would never go and pay to go hear this DJ on your own or this band. You had no idea who they were, that they were even going to be there. So in that case, you have to value the chicken dinner just like you do for IRS purposes. You value what that amount is, the fair market value of that is, and it doesn't matter if the charity's gotten that donated either. Just because it's donated doesn't mean that I, the person attending the event and paying the $100, isn't getting that value. So on my ticket, it has to say, or on the website, it has to say, you paid $100. You receive goods or services in return valued at $40. And then you should either add the additional sales tax, or you can say the total amount and break it down, $40, and you break down the amount that's for the actual meal and the amount of the sales tax. And that should be included on your ticket.
And that's where we think the Department of Revenue is going with this issue.
Right. But we're not sure.
We're not sure. The Department of Revenue has not issued that guidance yet. So what I'm advising folks is that until the Department of Revenue comes out with that guidance, if you sell that $100 ticket, whether the value is $5 or $50 for what's being received, you've got to collect sales tax on that entire $100. So you add the sales tax to the price. If you want to include it, then fine. You charge for the ticket. You charge $91 if it's in the city of Atlanta, and then you show $9 as sales tax, and there's your $100. But you've got to show that on the website or on the ticket itself. That's very important, because right now it's better to play safe than sorry, and you don't want to get into a situation where you've already collected all the monies from the participants, and then the Department of Revenue says, well, you should have collected sales tax on the entire $100 or the entire $91.
And the reason for that is because it's an admission. And they will argue that it's an admission to entertainment and activities.
And they'll argue that it's just an admission to do anything. My argument has always been, or concern is, that if I charge somebody $10 to walk into a room and breathe, that's subject to sales tax, because the definition of admission is so broad.
Right. So we're thinking that they're going to go the way I first described it, but for now, collect sales tax on the full amount. The other thing, though, to consider is, well, what if that DJ or band is, maybe you've got Maroon 5 coming, or Khalid is your DJ. It's a little different, right? Now you're really going to pay, and that's advertised. So you're paying an admission to hear that band or to hear that DJ. And that's real entertainment. And so the fair market value of what the donor is getting is far different. And so if it was $100, no matter what, I'm getting that value. So you're charging sales tax in the full amount regardless. And so if it's $500, then you can look at, well, what would you pay to go see, that kind of a musician or DJ, band, say at State Farm Arena. What are you paying as a ticket to go see Maroon 5? Well, or Mayor's Bank Amphitheater. And then you have to figure out the fair market value of that, plus whatever else they're getting, to do that same kind of calculation. So you have to really analyze and look at what is it that you're offering, assuming that the Department of Revenue does allow you to bifurcate, which we do not know that at this point yet, but we're hopeful that that's how they're going to come out.
When you're trying to determine, is this really an entertainment value, if it's just a DJ that nobody's ever heard of, a piece of advice or a good kind of rule of thumb is, if your website says, and by the way, we're having Mark the Magician at this event, so definitely that should be a reason to come. That's probably more of a reason to say that people are coming to the event for that particular Mark the Magician, and you should be collecting sales tax on the entire amount.
Yeah. All right, let's move quickly to silent auctions, because we are running over. But this is all really important information.
And we will have follow-up webcasts this summer.
Yes, we're going to have follow-up webcasts on several of these subjects that'll be individual webcasts just on those single subjects. Okay, so silent auctions, we need to break this down into two components. The first is the items that are donated to the 501c3 for the auction. So the donor has to pay the sales tax on the purchase of that item. If I donate a computer, I have to pay the sales tax. If I take that item out of inventory because I sell computers as a company, I have to pay the sales tax. And that's on the donor to manage that. Now, for the 501c3 that's selling the auction items, there's a really important process that you have to go through. First of all, you want to make sure that you find out the fair market value of the items that are donated. You're not going to put it on your acknowledgement receipt to the donor. You're going to say, thank you for the computer. But I want to know the value of that computer because I need to know that for my bid sheet. And there's an important reason why. So if the winning bid exceeds the fair market value, then you're only going to charge sales tax on the fair market value of the item. Over and above that, it's a donation. So you get a couple guys and they're trying to outbid each other on some item at an auction, and they're raising that price and they're raising that price, and they don't care that they've gone beyond fair market value. That over fair market value is a donation. And so you can bifurcate that into two separate transactions. Because it's on the silent auction sheet what that fair market value is. So let's say there's a signed football valued at $250 and it sells for $400. Well, you bifurcate it, you charge sales tax on the $250 because it's tangible personal property, And then you'd separately do a $150 donation. And there's no sales tax connected with that because it's a voluntary contribution. If the winning bid is less than or equal to fair market value, the whole amount is subject to sales tax. Now, I do recommend that at the bottom of your bid sheet, every bid sheet, it should say final bid is subject to sales tax. So that everybody knows that, yeah, maybe I put down $135 for my item, but I have to pay sales tax on top of that. So it's really clear to people when they go to check out that sales tax will be applied. Bundled transactions get really complicated. You often have these big baskets. And sometimes in the basket there might be services or gift cards combined with tangible personal property. So what portion of that are you charging sales tax on? So you really need to value and assess each one of those kinds of baskets and determine what percentage of that basket sales tax applies. And then depending on the amount of the winning bid, you apply that percentage and charge sales tax on that percentage. It's probably easier to do it on the whole thing, but I don't know how Richard feels about that.
Right. I think if you're able to bifurcate, you should bifurcate because not everything is subject to sales tax.
Right. Yes.
Okay. I just wanted to make sure we address that one question.
Yes.
About the question was,
If a 501c3 pays sales tax to the event venue, does the 501c3 have to charge this tax to the person buying the admission ticket?
Yes, absolutely. Yes.
The best analogy that I can give so that people understand it is when you go to a hotel, that hotel has purchased all kinds of things for your night stay. Soaps, toiletries, the furniture, they paid sales tax on all of that, believe me. They didn't purchase it for resale. When you pay the hotel, you're paying sales tax on the night stay. So it's the same kind of thing with the admission ticket. It's charged for admission, notwithstanding the fact that the purchases of the goods that are going to be provided in the event have been taxed already.
Mm-hmm. It's the combination of the whole thing that you're getting. It's something different.
Yeah.
You're not just getting this room. The purchaser is buying admission.
Yeah. And admission is something only separate from purchasing something for resale.
Right.
Very important concept, also very confusing concept. So I understand the question.
Right. Moving on to educational events. So let's say you have a famous anthropologist. Let's say it's Jane Goodall. And she is coming, and she's an author, she's got all these books, she's an expert, she's coming to town and she's going to speak. That is not considered entertainment. That is considered an educational presentation, and no sales tax is charged on that admission.
Let me qualify this. This is what we think the Department of Revenue is going to do. Let's go back to Richard Litwin's theory that if you charge admission for anything, sales tax is due. We still hold to that, but this is where we think the department's going with their guidance, is that they're going to say, okay, there's a line between what's really entertainment and amusement admissions and admissions for something more educational, like perhaps a continuing education event or something like that. They're not going to make us collect sales tax on that.
Exactly.
Just to clarify.
Yep. All right, we mentioned fun runs, half marathons, walk runs, whatever you want to talk about. They're all any kind of activity where you're running or walking outside.
You're charging an entry fee.
Yes, and so you charge a participation fee. It costs $25, $40, sometimes $50 to participate in that game or amusement activity. So it's a game or amusement activity and you're participating. You have to charge sales tax on that participation fee. It's also not considered a donation because it is the cost usually of what it is to participate. You're not paying $200 to participate in that. You're paying generally the fee, and sales tax is due on that. Oftentimes there's a t-shirt that might be given with that participation fee. The organization must be collecting or remitting sales tax, or must be paying sales tax on that t-shirt when they buy it because they are the end user. And that goes back to like that token item. That's where they're giving that item to the participant as a participant, someone who's participating in the event. And it's a marketing thing, and it's not, they're the end user. So that's where the sales tax is.
And sort of as we're getting towards the tail end of this webcast, it's probably important to make note of this right now. A lot of you out there are probably saying, we've never done this. We're not going to do it now. this is too complicated. No one does this. No one charges for sales tax on admissions. No one's charging sales tax on galas. No one's charging sales tax on entry fees. We had a situation last year where there was an event held in South Metro, and the tickets had already been purchased, and the event was contacted on Friday.
And the event was on Saturday.
And the event was on Saturday. And the Department of Revenue agent said, well, we see that you're having this big event in South Metro Atlanta. We're the regional office that oversees that part of the state, and we just wanted to remind you, you should be collecting sales tax on your tickets and on your ticket sales. And the the charity said, well, we've already sold all the tickets. They were purchased on the website. We haven't collected sales tax. The Department of Revenue said, well, then you're going to have to pay it. So,
and we're coming to the event to make sure that if you sell tickets there, that you're collecting sales tax.
So you don't want to be the example. You've got to take this seriously.
And one of the reasons we are doing these presentations, we've done this live several times and we're doing this webcast, is because the Department of Revenue is putting out this bulletin to specifically educate 501c3 organizations, because they intend to start auditing and checking on 501c3 organizations to make sure that they're in fact doing these things. So the last topic that we're going to cover very quickly is charity golf tournaments. So usually the way this works is the club gives the rounds of golf to the charity at half price. So, or at least at less than fair market value. The charity can use that ST5 form, that resale certificate form, to buy the rounds of golf. And then they're going to resell them. So then they have to charge sales tax on the amount of it, the participation for a round of golf in their charity event. So let's say they charge $145. So let's say they pay $75 to the golf club, and then they charge $145 for a round. And they can say that that includes tax. They can break it down as to what the $145 includes and include the actual amount of the sales tax, of course, based on where that golf club is the amount of the sales tax they have to collect and remit. But it's not a donation, because usually the amount that they're charging is the same as what it would cost to pay golf there. And so in that case, they have to collect sales tax on the full amount. Oftentimes there's a couple other pieces to golf tournaments, like a mulligan package. And usually a mulligan package is a donation. Those are the do-overs. You get 3 do-overs. If you pay $30, you get 3 do-overs on the course, which is great for those people that are out there having fun and could use those do-overs. You're not purchasing tangible personal property. You've already paid the admission to participate in the games and amusement, and paid sales tax on that. This is just a gimme. And so there's no sales tax to be charged on that. However, if you include a food or drink ticket in there, or you include some kind of item that they're purchasing as well, that they're getting for that, then you might have to collect sales tax. So keep it clean, keep it just the do-overs, and then you don't have to worry about it. Also, there's often gift bags. Now, unless the gift bag is advertised on the ticket, like we talked about, they have no idea what you're getting in the gift bag. When you pay the $145 to participate in the golf tournament, you don't know that you're getting a gift bag. You don't know what's included in it. You have no idea. It's truly a gift. So there's no sales tax applicable with regards to the gift bag. Now, the items purchased, the end user, whoever donated them, however that works, sales tax is applied. We're not going to go into that again. But let's spend a minute talking about sponsorship packages. So oftentimes with these golf tournaments, people are giving big sponsorships, and they might get a foursome included with their sponsorship back. So they're getting the value of $145 times 4, $580 of golf. And sales tax has to be charged on that portion of the sponsorship for that, or has to be recognized as that portion of the sponsorship. So the $5,000 has to be, you say goods or services were received in the amount of $580, including sales tax, or you break it down and say the actual amounts of the actual value plus the amount of the sales tax that's applied.
And as a footnote to what you just said, Robin, we talked about this yesterday. There are other events like galas where there are sponsorships for a table up front, and you've got to consider that as well. If there's a $5,000 for 10 seats at a table up front in the front of the room, maybe a lot of that was a contribution, but some of that is for the actual food and the drink.
And that's going to be true from an IRS perspective, but also the sales tax perspective, and you have to consider that.
And again, remember, when I say you can bifurcate as to these tournaments, the sponsorship packages, that's just what we think the department's going to do. Right now, my position is if you charge $5,000 per admission, you got to collect the sales tax on the $5,000.
Well, not on the whole sponsorship,
Well,
but on the value of the items
Right.
that you're getting.
Right.
In that case, it's very clear that a portion of that is sponsorship.
okay.
Because it's not admission. The only admission is the 4 items. So I think on the 580,
You think
for
we're
the
safe?
$140,
You think we're
I think we're
safe?
safe because it has nothing to do with admission.
Right.
For the
I
5,000.
still would say be clear about maybe on that receipt for the sponsorship or of the
Yes.
table, put something there that, says,
Oh,
a lot of this is a contribution.
the sponsorship is $4,420,
Right.
right? And then you're purchasing golf, or
Right.
in this case, the example, or you're purchasing gala tickets valued at $580 if it's $145 ticket, and then sales tax is charged on that amount.
All right.
We have one question to close this out. What if your tickets state that the compensation is of $0 value?
If they're showing up and there's no food, there's no drink, there's no entertainment, then maybe it is $0 value. But if you're getting anything in return, it's not $0 value.
And again, even though there's no value, this is just what we think the department's going to do. Right now, our position is if you charge $100, you got to walk in a room and breathe. You got to collect the sales tax.
All right, thank you.
Yes.